When the Calgary Real Estate Board released their official forecast for the Calgary housing market in 2025, they told us how many homes would sell, how prices would move, and which property types would outperform. These forecasts shaped expectations for buyers, sellers, and investors heading into this year. Now that we have some of the most recent stats, we can finally do something that most people never do: hold the forecast accountable. Today, I'm comparing what the Real Estate Board predicted for 2025 versus what the market actually did. And some of the forecast was accurate, and some was very wrong. Now, I love looking at the market data, not just the headlines. The forecasts matter, but only if we're willing to measure them against reality. So, we're breaking down the 2025 forecast and comparing it directly to the real numbers we've seen play out through the year. Let's start with what was originally predicted. Heading into 2025, the outlook for Calgary was optimistic but measured. The forecast called for approximately 2,685 total residential sales across the city. Price growth was expected to remain positive, with an overall benchmark increase of around 2.7%. By property type, the expectations were clear. Detached homes were forecasted to grow by just under 3%. Semi-detached homes were expected to rise slightly more. Row housing was projected to outperform, and apartments were still expected to see modest price growth. The overall theme was strong but more balanced market with steady demand and moderate appreciation across all housing types. At the time, the outlook made sense. Population growth was strong, inventory levels were relatively tight, and Calgary had been outperforming most major Canadian markets. But forecasts are only useful if they hold up once the year actually plays out. Now let's look at the real data, which gives us a clear picture of how the year unfolded. By November, Calgary recorded 2,100 sales. By November, Calgary recorded just under 22,000 sales, which was down roughly 16% year over year. Inventory had climbed to 5,581 active listings, an increase of about 28% from the previous year. Months of supply rose to 3.59, placing the market firmly in balanced territory. More importantly, the overall benchmark price sat at $559,000, which was down approximately 4.6% year over year. That immediately highlights the first major disconnect between the forecast and reality. Prices did not grow, they declined. Instead of a modest 2 to 3% increase, like they said was going to happen, the market in November, because we don't have December stats yet, finished nearly 5% lower than the year before. That tells us the forecast was directly optimistic when it came to pricing. But the real story becomes clearer when we break this down by property type. For detached homes, they were expected to be one of the stronger performers in 2025. In reality, by November 2025, the detached benchmark price sat at $733,000, down roughly 2% year over year. Sales were slightly lower, inventory rose sharply, and months of supply moved close to 3 months. Detached homes did not crash, but they also did not deliver the price growth that was forecasted. Rising inventory and affordability limits capped appreciation entirely. Compared to that forecast, detached pricing missed by roughly 5 percentage points. Semi-detached homes. Now they were close, but still short. This was the closest to meeting the expectations. By the end of November, the benchmark price for the semis sat at $671,700, essentially flat to slightly down year over year. Sales eased modestly while inventory increased significantly, pushing months of supply above 3 months. Semis benefited from relative affordability compared to detached homes, but inventory growth prevented meaningful price appreciation. The forecast expected growth. The reality was stability at best. Now, this is where the forecast really began to completely break down. Townhome row homes were a major miss. The row and townhome properties were expected to outperform in 2025. Instead, the benchmark price had fallen $424,400, representing a decline of more than 6% year over year. Sales dropped sharply, inventory climbed, and months of supply rose into a clearly balanced territory. The forecast did not account for how quickly supply would build in this segment, particularly from new construction. Investor demand also cooled, and first-time home buyers became more selective. Instead of leading the market, row homes significantly underperformed expectations. Now, this is where we see the biggest forecast failure. Apartments and condos saw the largest gap between predictions and reality. By the end of November, the apartment benchmark price had fallen to $309,300, down more than 7% year over year. Sales dropped sharply, inventory increased, and months of supply rose to 5.5 months, placing the segment firmly in a buyer's market. The forecast expected modest growth. What actually happened was sustained price pressure. Improved rental supply, investor pullback, and buyers upgrading directly into higher housing types all weighed on demand. This segment ended 2025 in the exact opposite position than forecasted. CREB projected 26,850 total sales for 2025. Did it hit the target? Now, by the end of November, Calgary was well behind that pace. To hit the forecast for the end of December, you would have to have one of the strongest Decembers in record, in history, something that historically is very unlikely. This tells us sales projections were too aggressive, especially given rising inventory and cooling demand in the second half of the year. So, was the forecast wrong? Here's the fair and balanced verdict. The Calgary Real Estate Board correctly anticipated a shift toward more balanced conditions. Inventory did rise, competition eased, and pace slowed compared to the previous boom years. Where the forecast missed was on the pricing direction, particularly in the row and apartment housing. It also underestimated how quickly buyer leverage would return and how strongly rental supply would impact ownership demand. In short, the forecast was directionally right, but numerically wrong, especially on the prices. What does this mean heading into 2026? Based on how 2025 actually played out, the outlook for 2026 looks very different than what many expected years ago. The detached and semi-detached homes are likely to remain stable and range-bound unless there's a sudden demand surge. Sellers will need to price accurately and competitively. Row and apartment segments continue to offer the best value for buyers, with pressure likely extending into early 2026 and negotiations remaining common. Overall, 2026 begins as a balanced to buyer-leaning market, not a runaway seller's market. That is a meaningful shift and one that strategy needs to reflect. Forecasts are useful, but real-time data always wins. The Calgary Real Estate Board got the direction right on balance, but the numbers were missed, especially on pricing and affordability-driven segments. Understanding what actually happened in 2025 is key to making better decisions heading into 2026. If you're buying, selling, or investing as we head into the new year and want a strategy based on what the market is truly doing, not what it's supposed to be doing, I'm happy to help. Reach out anytime if you want a breakdown for your specific property type or neighborhood. And once again, click the link in the bio to book a call, like, subscribe. Thank you for watching.